And Michael Jones, CEO and Chairman of Caravel Concepts. Michael, thanks for joining us this morning. Welcome to the show. What's your reaction so far to how the markets are reacting in the aftermath of the February jobs report?
I think markets continue to be a little sanguine about how the Fed is going to react to these numbers. I think the theme throughout 2023 is underestimating how the Fed will react to the ongoing strength in the economy. This morning, the theme has been, oh yeah, job gains are still pretty strong, but the wage gains were not as robust as we might have feared. I don't think that's where the Fed's head is. The Fed's head, I think, is continuing to focus on, if we're continuing to get job gains, then ultimately wage gains are going to continue to be stronger than we want them to be. And that means 50 basis point increases are very much back on the table. And I think what the investors, I think, are underestimating is what risks continue to be in financial markets if the Fed puts 50 basis points back on the table. When the Fed tightens as aggressively and as persistently as they have for the last year, we see financial crises unexpectedly pop up and surprise us. And I think we're starting to see that potential come out. I think that's what the Silicon Valley situation is warning us, is that we've now tightened long enough, hard enough to see the kind of risks of a financial crisis that could really bite investors really hard. And I don't think investors are paying enough attention to those risks.
Yeah, Michael, I mean, that optimism is really interesting, particularly on the back of 2 days of testimony from Fed Chair Jerome Powell. You've indicated that you think the Fed has already sort of decided here to make their move 50 basis points. So if that does end up being the case, what should investors be watching? How should they navigate what's to come here?
Well, I personally think that it's time for investors to take Fed Chairman Powell at his word. He seems monotonically focused on fighting inflation, and he's ignoring any other risks to the economy. And that, to me, means that investors ought to be pulling money off the table. I think we've gotten an opportunity to take a little bit more risk off the table. And I also want to remind investors that it's not just slowing economy that comes, that's not the only risk that investors face when the Fed is tightening. I'm old, so I remember, when portfolio insurance was the thing that took financial markets down back in 1987. I remember when it was the Russian default in 1998. And of course, everybody remembers the mortgage crisis in 2008. The Fed tightening cycle brings more risks than simply the potential for recession. And I think what we're seeing right now is that banks are at risk because the fast tightening coming up from historic lows in interest rates, this rapid tightening cycle has left banks with big losses in their bond portfolios. And banks like Silicon Valley Bank that get a run, that have to meet liquidity needs, when they sell those bonds to meet those liquidity needs, they're going to incur large losses. And that creates an ongoing spiral of bank runs. That may be the financial crisis that this tightening cycle brings into the financial markets. Investors don't seem to be paying any attention to that risk at all, with the exception of the specific banks that could be at risk. I think that is something that investors need to be paying attention to. Frankly, I think it's something that the Federal Reserve should be paying attention to, but they don't seem to. So for right now, if what I'm doing in my portfolio, what I think investors should be looking to do is take some chips off the table, get more cautious, because this tightening cycle isn't done, and the risks to investors are far from over from this tightening cycle.
I'm glad you brought up Silicon Valley Bank there, because that's a story that we've, of course, been following all morning here. What are the implications if this does continue to happen, and with other banks, as you kind of mentioned there, and how do you think investors and, everyday Americans can navigate this moving forward? What strategies would you kind of recommend here?
So first, we need to recognize that this is not a problem unique to Silicon Valley Bank. Every bank has a liquidity portfolio of bonds. That's what from a regulatory perspective, they have to. They have to be ready to meet depositor withdrawals by selling liquid bonds and meet those depositor outflows. All right. Now, normally that's totally safe. Everything's fine. They're short maturity, 2, 3, 4-year bonds. It's not risky stuff at all. But when the Fed raises interest rates as dramatically as they have over the last year, those bond portfolios can incur significant losses. All right. That's still not a problem unless the bank incurs significant depositor outflows. That's what happened with Silicon Valley Bank. That's a unique situation to Silicon Valley Bank because of their unique business model. But the risk is that every bank is sitting on similar losses in their bond portfolio. If the unique situation of Silicon Valley Bank and the things that made them vulnerable to a bank run, if people recognize that there are similar losses at every other bank, and those fears start spreading, and you see a more widespread bank run that starts going from much more solidly capitalized, much more diversified business model banks. Fear isn't necessarily a rational thing. And if you see the fear that hit Silicon Valley spread to some of their more well-capitalized, more diversified business model banks, then the losses that Silicon Valley incurred, those same losses are in every bank in the country. And you could see a more widespread run. I just think that people are being too sanguine about the consequences of the Fed tightening cycle and what it has meant for the fragility of the banking system for the time being.
Right. Michael Jones, thank you so much for breaking down this important story for us. He's the CEO and chairman of Caravel Concepts. Thanks again for joining us.